Welcome to Sawyer's Silver Vault. The digital gold rush is over. The era of easy 60K Bitcoin is officially in the rearview mirror. And right now, we are watching the foundations of the crypto economy shake in real time. But here is the question that separates the retail traders from the institutional whales. Is this the final capitulation before the next halving cycle ignites? Or are we staring down the barrel of a full-blown crypto winter that could wipe 50% off the table? Don't click off this video. I know you are scared. I know your portfolio is bleeding red, and you are looking for someone to tell you to sell. But I am going to give you something more valuable than hopium. I am going to give you the truth about what is happening on-chain, why the institutions are running for the exits, and the exact price levels where the giants are waiting to buy. Because if you only watch one Bitcoin update this week, it has to be this one. The data coming out of the ETF flows right now is flashing a warning signal we haven't seen since the FTX collapse. And the largest corporate holder of Bitcoin just did something they haven't done in years. We are breaking down the massive $4.4 billion exodus, the $62,000 breakdown, and why Standard Chartered is actually calling this the buying zone. Hit that like button if you are ready to navigate the volatility, and let's get that silver lining on the vault. We have to start with the price action because the charts don't lie. Bitcoin just wrapped up one of its most brutal trading weeks of the entire year. After failing to hold the psychological $70,000 level, we have seen a cascade of liquidations that pushed the King crypto down to a local low near $61,500 overnight. As we speak, Bitcoin is hovering around the $62,700 mark, struggling to reclaim any sort of bullish momentum. This isn't just a dip, this is a structural breakdown. We have officially sliced through the 50-day and 100-day moving averages like a hot knife through butter, and the 200-day is now firmly in the rearview mirror. Technically speaking, the market structure is bearish until proven otherwise. The Relative Strength Index, or RSI, has dipped into oversold territory, below 20 on some timeframes, a level that historically precedes a snapback rally. But in a market this fearful, oversold can stay oversold for longer than your trading account can stay solvent. So, what broke the camel's back? The answer is simple. Institutional demand has evaporated. We are witnessing a historic unwind in the spot Bitcoin ETFs. For 13 consecutive trading days, we have seen net outflows, culminating in a staggering $4.4 billion pulled out of these products since mid-May. That is a record streak. Think about that for a second. When the ETFs launched, everyone celebrated Wall Street buying the dip. But right now, Wall Street is selling the rip. Or rather, they are selling the fear. Total assets under management in these funds have dropped from $104 billion to just over $80 billion. That is a massive contraction in demand. It tells us that the marginal buyer who pushed us from 40K to 70K is now a marginal seller. And when you remove that bid from the market, gravity takes over. We saw a tiny inflow of $3 million yesterday, but in the context of a $4.4 billion bleed, that is like throwing a bucket of water on a house fire. Now, let's talk about the elephant in the room, strategy, formerly known as MicroStrategy. For years, this company has been the ultimate Bitcoin bull, buying the top and the bottom with relentless conviction. But last week, for the first time since 2022, they actually sold some Bitcoin. It was a small amount, just 32 BTC, but the psychological damage is done. The market is now acutely aware that the world's largest corporate treasury is sitting on a massive unrealized loss. Their average cost basis is roughly $75,500 per coin, and with Bitcoin at $62,000, they are deep underwater. Grayscale's research head pointed out that Strategy's leveraged business model is under pressure, and their ability to keep accumulating more Bitcoin is now limited. If the buying stops, the support crumbles. The market is watching to see if they are forced to sell more to cover obligations, and that uncertainty alone is enough to keep a lid on prices. We also need to look at the macro backdrop, because crypto doesn't exist in a vacuum. The market is rotating. There is a massive liquidity shift happening away from non-yielding assets like Bitcoin and into artificial intelligence equities and mega-cap IPOs. We are talking about SpaceX, OpenAI, and Anthropic. The narrative on Wall Street has changed. Why hold Bitcoin when you can chase the AI bubble, or rather, the AI revolution? On top of that, the geopolitical tensions, specifically the renewed conflict involving Iran, have sent a wave of risk aversion across global markets. When you combine war premiums with a hawkish Federal Reserve that is in no hurry to cut rates, you get a toxic cocktail for speculative assets. The Coinbase premium, which tracks whether US investors are buying or selling, has turned deeply negative, indicating that American retail and institutions are currently absent. But here is where we separate the winners from the losers. We need to look at the levels. Right now, the immediate battlefield is $62,000. If we lose that, the next up is the psychological $60,000 handle. A break below $60,000 opens the gates to a potential crash toward the mid $50,000 range. Analysts at CryptoQuant are watching the $54,000 level as the final defense line. They note that the average realized price for the entire network sits around $54,000, and the long-term holder cost basis is near $49,000. If we break below $54,000, we enter full capitulation territory, the kind of washout that marks the absolute bottom of a cycle. However, there is a contrarian view that is very interesting. Standard Chartered just issued a warning, but inside that warning, they told clients this might be the buying zone. They still have a year-end target of $100,000, arguing that previous bear markets ended exactly around these moving average levels. The options market is also a mess. We had a massive $1.89 billion expiry today, with max pain for Bitcoin set at $70,500, far above current prices. This tells us the dealers are comfortable, and the pain is on the call buyers. So, what do? Volatility breeds opportunity, but only if you survive. The options data shows that traders are hedging heavily, buying puts for protection, rather than making straight-up crash bets. That is smart money behavior. They aren't panic selling, they are insuring their portfolios. For the rest of us, we need to watch the $60,000 to $62,000 zone. If we lose it, the flush to $55,000 happens fast. If we reclaim $64,000 with volume, the relief rally could be violent due to the oversold conditions. Watch the ETF flows like a hawk. When the bleeding stops, that is your first signal. Until then, patience is a weapon. This is a pivotal moment for the cycle. The fear is real, the leverage is being cleared, and the weak hands are being ejected. But remember, the Bitcoin network doesn't care about the price. It keeps humming along. As always, I will be watching the charts and the on-chain data, so you don't have to. Stay safe out there, don't over-leverage, and keep your powder dry. For more amazing videos like this, subscribe to our channel, Sawyer Silver Vault News.